Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, August 28th, and this is the weekly market update. So the first thing I wanted to go over was this reminder from Benjamin Graham, value investor extraordinaire. The margin of safety is always dependent on the price paid. And I've talked about this in a couple of videos recently, one specifically on overvaluation and different metrics that are used to measure it, and that the historical narrative is that if you overpay for stocks, your forward returns have a tendency to be below average. And so why am I talking about this again? Well, I was writing the current newsletter for the subscribers for the September issue of the Actionable Intelligence Alert newsletter. And in reviewing a couple of the companies, I was struck by the fact that even though their performance had been fairly good this year, they still were trading extremely well below their net asset value. And both of the companies are companies that are focused in upcoming emerging markets outside the US. And so they already had relatively low valuations. Now, these particular companies have unique business models that allow them to take advantage of the growth that's happening and unique situations that are particular to each company. But it just reminded me, like, I think one of the companies was selling at a 53% discount to its net asset value, and its net asset value had grown 22% this year. So that's the kind of situations you're looking for, right? That's something I like to buy. If I can buy 50 cents for $1, or $1 for 50 cents, I'm sorry, or 53 cents, and that dollar is getting turned into $1.25 while I'm buying it at a discount, it's great. The management of that company recognizes the historic undervaluation and is buying back shares. The other company is kind of a weird deal, but it has a very dynamic and shareholder-focused management team. It has been able to generate tremendous amounts of investment returns, and it has been buying back a tremendous amount of stock. That's another company that I believe its net asset value is around $1.20, and it's selling for around 80 cents. So you're getting about a 30% discount to net asset value with a tremendous amount of share buybacks and a new business that's coming online that looks promising. So those are the types of things that, we just don't do resource speculations in the Actionable Intelligence Alert newsletter. I'm looking to diversify out of overvalued situations. And at some point, we're going to have to sell these resource companies, these commodity stocks. They're not buy and hold investments. They are cyclical investments or speculations. And we've done very well in them, but we have to look for places to recycle the cash. And I'm looking for places that have been undervalued, and emerging markets have been undervalued for a decade now. And as I've pointed out in a previous video, a lot of times we'll see big moves and switches in overvaluation and undervaluation between the US and emerging markets. Typically, when emerging markets are outperforming, the US is underperforming. So with historic valuations in the US and not necessarily historic undervaluations in emerging markets, but very relative to the US, to the S&P, emerging markets are like, if not at all-time lows, close to. So that's what I'm looking at. So if you have an interest in that, you may want to take a subscription to the newsletter. The pick for September is also another undervalued situation. It's a unique way to play the dynamic economic growth that's happening in India that keeps you kind of away from the overvalued Indian stock market to a certain extent, but allows you to invest along with a Canadian billionaire who is of Indian descent and has set up a very interesting vehicle to take part in what I look at as possibly the doubling of the Indian middle class over the next 10 years. So if you have an interest in that, you can go to a Patreon site. A $5 support of becoming a Patreon will get you a copy of that when it comes out in September. You have to wait till September, But if you're interested in undervalued situations that give you this margin of safety, when I think that we have these overvalued markets, something may be interested in. So that's a short plug for the newsletter, but that's what we're doing in the newsletter currently. Just wanted to update people if they were interested. So I keep putting these things together when I find them about the historic overvaluation that we're currently seeing. And this is just another metric. It's the S&P 500 versus real earnings yield. You will note that when the real earnings yield approached zero or got below zero, it pretty much coincided with stock market corrections that happened that were pretty decent. We are now in a situation where we are below the historic norms. I would suggest that I'm not sure if this data takes into consideration the pandemic, economic decline. I mean, that's really exacerbated things, but nevertheless, I don't know if this has been recalibrated for the bounce back that we've seen in the economy in the $8 trillion of printed money. I will tell you, though, that this is just another metric of how overvalued things are. And now we have, Mr. Powell at Jackson Hole virtual conference kind of didn't seem to, the market liked what he said vis-a-vis the taper yesterday. But it's inevitable at some point. You have a lot of Fed governors out there saying that the taper has to begin at some point, start tapering the bond purchases, which leads us down the path to an eventual interest rate hike. I'm not, with markets elevated so high and so overvalued, I'm wondering if this may be the catalyst that causes a significant correction or maybe a bear market. I don't know. The future's unknowable, but it's definitely a risk, right? They're talking about this stuff, and it's not something that's been, we knew it was coming, but maybe it gets priced in. Maybe people look past it. I don't know, but we're in very choppy water, if you will. And again, the analogy has been used and metaphor that people have heard, however you want to call it, picking up dimes in front of a steamroller. If you trip and fall, you're going to get run over. And how much more upside is there? As I've said before, though, and I just said it before, and I'll say it again, the future's unknowable. It's even at these historic overvaluations, it doesn't mean things can get more overvalued. But you better move close to the door, because the music is eventually going to stop, and you want to get out before the crowd. So something to be cognizant of. So this was an interesting chart. So the best performing sector in the S&P this year has been the S&P 500 energy portion of the index, up so far 44.5% to this time so far. Well, at least through June. This was an older chart, sorry. But even now, last week, we had a big rally. We had this through the summer. People were getting concerned, even in the newsletter. We had a big run in a lot of the resource stocks. I mean, we've made a tremendous amount of money. But in the last couple of months, we've had a pullback, from the last time the Fed opened their mouth and they started talking about maybe moving things forward, but didn't actually do anything. I mean, we were poised for a correction. And, we've subsequently recaptured, or we've re-rallied. So I don't know if it's just a bounce and we're going to continue down in the resource sector, or if we're going to see continued strength into the end of the year. It's very possible. But what I'm seeing in the energy sector is interesting. The returns in a lot of the companies that we've been invested in or talk about have been tremendous, or been outperforming the market, but still generalist investors hate the energy sector. When I talk about the energy sector, I'm not talking about renewables. I'm talking about oil and gas, coal, nuclear, things like that. And they've performed very nicely, but the generalist investor still has not returned. So I call that, climbing a wall of worry. At some point, with these cash flow yields, with some of these companies being in the high 20% range or even higher for some companies, there's really some unique situations out there, and companies generating tremendous amounts of cash. At some point, the generalist investor has to come back, in my view. It's just, you're going to underperform if you don't have a positions in these. So we're climbing that wall of worry. I think that energy will continue to outperform, as I said, and I'll talk about in some subsequent slides. I think we're continuing to head towards that energy crisis and higher energy prices in our relatively close future, 18 months out or so. So yeah, just wanted to point this out. And here's something interesting. A lot of these charts came through. I had them, and some reason they just data dumped. They were like held up. I forward things to my email, and all of a sudden a lot of these may be a couple months old, but I still think they're relevant because they're still apropos. And this is OECD crude oil stocks. This is a Organization of Economic Cooperation and Development, which is basically your developed countries, Europe, the United States, Canada, that stuff. And you can see, our oil inventories worldwide. I mean, here's your 5-year average. Here's where we are in 2021, and we've actually went down even further. We are in deficit situation as we speak right now, and this is in the context of this so-called variant that's going around, which has caused certain countries not to be able to open back up fully, and still constricted economic activity. And so ask yourself what happens, if you look at worldometer data, which is what I just use, it's convenient. You have the ability to throw up a 7-day rolling average. You can take a look at the world as a whole, various countries. In the US, you can break it down to state levels, and you can see that, yes, we've had a lot more cases. Deaths have not been as bad as the previous wave, but they appear, at least from the context of a lot of the data I'm looking at, it's beginning to top out and roll over. And so, even Bank of America, their commodity people came out with a note this week and said that by mid-August, should definitely be apparent that this particular wave of this sickness will have rolled over. So, of course, the market's going to anticipate this. It's not going to wait until the data comes in. And so I think that's what you're seeing. You're seeing the more dovish comments from Powell this week, combined with the fact that what was holding things back a bit, I think, was this uncertainty around how bad this particular wave would be of the pandemic. And I think now that the data seems to be indicating that it's rolling over. It's not good for, people are very gun shy around this whole discussion. And so when we saw the rising cases, people immediately extrapolate. You have to, it's about risk management. So people start extrapolating worst case scenarios, but it looks like things are rolling over, and that, nothing's really changed on the supply dynamic. I'm going to show that in some slides coming up. Are we prepared to go back to 100 million barrels of demand? And then as growth continues worldwide this year and into next year, will we be able to supply the crude with the call that will happen on OPEC? Will they be able to meet the call? So B of A in their letter is expecting $80 Brent this year, which is only about $8 or $9 from where we are now. I think that's consistent with what Goldman said. I thought we would get 70 by the end of this year. We've already bumped up against that, then pulled back, and now Brent's over 70 again. So we've met my target. I think we go higher into the end of the year. Personally, I don't know how high. 80 seems reasonable. 75, 80 seems reasonable. And the thing I like about it is I've been listening to a lot of conference calls of various, obviously, constituents of the newsletter portfolio, but other companies also. And, $70 oil Brent does a real good trick for people's cash flows. I mean, I've got companies that have exploding cash flows. Okay. And if you think we're going to go higher, that just gets better. And so it's something to look at. If you don't have a position, people have asked me, is it over? I don't think it's over. These things usually go in they're cyclical type situations. Eventually the oil price will get high enough where enough drilling will come in and will overwhelm the demand. But I think we're a long way from that. As I said before, because of the ESG situation, because of the constraints being put on by this current administration on North American production, and the disincentive to, just because of what we've seen around environmental, like I said, ESG, as our friend Harris Kupperman calls it. Oh, what's he called? ESG? I just forgot. I just lost my train of thought. Energy stops growing. So yeah, it's funny, but it's actually true. So I don't know if oil goes down. We're heading into the shoulder season as driving, slows down. But as this current wave rolls over, we'll see as more economies open up and things begin to return to normal. It's a news cycle, right? I mean, it's the same thing like it happened in India. That's why I'm buying an Indian company this month in the newsletter, because if you look at what's going on there, yes, the economy got bombed out because of the super bad news that we had over there a couple months ago, but things have really mellowed out. And so you will see humans are going to human, right? The longest trend in effect for mankind is mankind's ascent. So that goes from the lower left of the chart to the upper right. There will be ups and downs in that, but you can be assured that people will have commerce. People will start moving projects forward and doing things that they want to do, and that all requires energy. So pursuant to the previous comments, here's a slide from Rystad. North America frac operations by month as of 18 August. And you can see, even with the oil prices that we've seen, or the rising oil prices, you see the depths of the pandemic reduction in activity and then the gradual climb. But even with these prices at, close to $70 WTI, high 60s, they've been up there for a while now, you're not seeing a big, increase in frac operations. Now, is this because of activity levels? Is it because that companies are not drilling as much and don't have the need to frac as many wells? Is this part of the situation where you have the drilled but uncompleted wells are starting to, we're starting to run out of those type of situations? Is it like Goring and Rosenzweig have suggested that a lot of the tier one drilling locations have already been drilled out, and there's really not a lot of choice places to drill, even at these prices, and so you don't need many frac operations? These are all questions that are reasonable to ask. I just point out the fact that during previous times in the last decade, when we've seen an increase in the oil price, we've seen a consummate, pretty sharp and quick rebound in drilling and fracking operations, and we just are not seeing that now. Kind of recovered from the basically crash back here in the spring of 20, after the whole pandemic hit the United States, but then started climbing out of that. And we really haven't been, I don't know if oil prices have to go $100, $120 a barrel, something will re-stimulate this, because at some point, even second tier locations become profitable to drill. So another data point that seems to me to be bullish, that you're not seeing the supply response at these prices. So I wanted to point this out. This is another article, and I'll put a link to it. Where I call out articles, I'll try to put links to them in the show notes. So this is a Bloomberg article. The era of cheap gas is over. The era of cheap gas, natural gas, is over, giving way to an age of far more costly energy that will create ripple effects across the global economy. Natural gas used to generate electricity and heat homes was abundant and cheap during much of the last decade amid a boom in supply from the US to Australia. This is exactly right. That came crashing to a halt this year as demand drastically outpaced new supply. European gas rates reached a record this week, while deliveries of the liquefied fuel to Asia are near an all-time high for this time of year. And you're seeing gas in the US like at $4.20 an MCF, where it was at $2.50 an MCF a few months ago. And that's been really great for unhedged producers like Sandridge Energy. We've talked about that in the free part of this stock that's really performed well for us. Shout out to other folks that brought that to our attention. But that's what you want in this type of environment, right? You've got to be careful if you want to take advantage. And the reason I'm bringing this up, there's going to be a lot of talk now about, I think gas prices are going to go a lot higher. I think that this winter is going to be a little bit colder and arrive sooner. Not a little bit, I think a lot colder and going to arrive sooner than people think. I think that's going to put a tremendous amount of demand on our inventories, which is a problem. And so I don't think it's outside the realm of possibility that you see $6 gas and a spike maybe if things get really nasty. And you don't want to be holding a gas producer these types of situations in gas, they're not like long-term trends. A lot of the times they get spikes and then you get a big move in the share prices. Unless we go to some new high of $4 or $5 just because supply. But I still believe in economics, and if the price gets high enough, the supply response will come. So we can't discount that. Nevertheless, I think the way to play this, if you think natural gas prices are going to be moving higher, even at these prices, you want to be looking at unhedged producers, because if you own a producer that has his gas hedged at 250 or 275 MCF, when gas prices are going for 425 or maybe 5 or 6 this winter, you're leaving a lot of money on the table. So I would caution, if you are going to get involved in this and try to play it, that you stick with the unhedged producers. Now, the same thing applies on the downside. If you get a big move down in gas prices, they don't have any hedging in place, there's going to be the price taker at that whatever price. So it's interesting to look at this. This particular article seems to think there's going to be a new higher floor because of some of the things that are going on with supply and demand with gas. It's a good article to read. I'm not sure exactly where I think gas is going. I think it'll be higher over the winter, but I want to see if there's going to be a supply response if prices get to $5 or $6 an MCF, and see if drilling explodes in the various gas basins. So there's a quote here also. It says, and this is why I think this particular article seems to be moving towards the new higher floor. It says, no matter how you look at it, gas will be the transition fuel for decades to come, as major economies are committed to reach carbon emission targets. The price of gas is more likely to stay elevated over the medium term and to rise over the long term. Well, we'll have to see. Like I said, the future is unknowable. That case can be made, but we would, like I said, we want to see what the supply response would be. Nevertheless, I think into the end of the year and into the part of the winter of 2022, I think that gas prices will be moving higher. So this is something else I want to talk about. So this is a chart that Contrarian 8888 put up, and this is basically the percentage of 2021 U.S. production by entitlement. Basically, you have all these different oil companies here, like Chevron and ConocoPhillips and Occidental and ExxonMobil, and what their percentage of U.S. production is as per the total. So like Chevron, the way I read this chart is that they're 7% of the total U.S. production. And you see smaller companies out here. Obviously, your bigger companies have bigger, you see EOG Resources here, one of the top shale players, supplies 5% of the U.S. produced oil. So you got Shell, BP, all the big ones, Pioneer Natural Resources. Anyway, so what's the point? The point is that, two things that I think is happening in North America, or at least in the United States and the shale basins and oil production as a whole. The ESG movement, the ability for people to influence these oil companies and try to get them to become carbon, whatever, neutral or friendly, whatever the term is, to basically get away from their core expertise and business model, which is the finding and production of oil and gas. And so how does that happen? Well, this is the passive fund ownership in each company. So you see that, passive, I mean, like companies like these funds like BlackRock and ETFs and stuff like that, pension funds, kind of longer term passive investors. Well, what you had, like in the situation where Exxon, where you had a smaller activist fund, if you will, that didn't really have the resources to buy enough Exxon stock and really affect an outcome, is they riled up or got the backing of some of these other passive funds like BlackRock, and BlackRock committed their shares to the effort. And you see that you see some changes in the board of directors at Exxon, and they were one of the last companies that was like trying to just hold to their what their basis of their company was, oil production. So they were actually trying to grow oil production. And so I think this is another brick in the wall of the strangulated supply that we're going to see over time, as you have these passive investors pressuring these companies to basically don't produce any more oil, don't reinvest in these assets that they think are going to go away. I mean, I don't understand why these investors just don't sell these companies and not hold the stock, but I'm not going to get into, conspiracy or trying to speculate that, BlackRock is, taking the other side of the green, it's $7 or $8 trillion under management. So they're taking the other side on renewables and then trying to force these oil companies not to produce any more oil and gas, and that will ostensibly, create more demand for renewables. I'm not going to go there. I just think there's a lot of confused people in the world nowadays, and there's a lot of people that don't really understand how a modern society works and what the inputs are into that society. And I think that they have views that are diametrically opposed to each other, and they will not realize that until they have to suffer some type of pain, physical or mental trauma, financial trauma that will get them to have no other choice but to reverse their view. So as we await that, our position is that heads we win, tails we win more, and that oil and gas isn't going away for many decades. It's actually going to grow in demand. And if you constrain the supply, when demand's growing, you're going to have a price rise. So this was another one of the news items that got data dumped that was stuck in my email, and all of a sudden came out this week. There was like 20 emails that's what I do. I go around and look for different things, or all the reading that I do. And if I see something interesting, I'll take a link and email it to myself. And some of the stuff wasn't coming through. I did something with my email, and all of a sudden it data dumped all this stuff in 1 week. So this news is a little bit old. I'll put a link to the article, but it was talking about a major hedge fund that was behind the Amazon MGM Holdings merger. New York hedge fund Anchorage Capital Group has amassed a holding of a few million pounds of uranium. People familiar with the matter say, in a bet that prices of the nuclear fuel will recover after a decade in the doldrums. It is buying and selling uranium alongside mining companies, specialist traders, and utility firms with nuclear power plants, turning the fund into a significant player in the market. And so this happened. This is what we talked about would happen. This is even before the Sprott thing really became in effect, which it is in effect now, and apparently is putting pressure on the spot market. I'm trying to get Justin Hune on. He's been traveling. I'll try to get him on because I'd rather have him delve into these things. He lives and breathes the uranium market, and I have corresponded with him, and he said he'll come on. We just need to get him hooked up and get him on. But it's obvious, you have a market that we know is supply constrained. You're adding this pressure on the demand side, where you have now this money coming in from the Sprott fund, and there's many other hedge funds besides this that can see this. They can look at the chart and see that we're in an uptrend. And so I think you'll see more of this. You'll see more money come in. I think that a lot of these companies, these hedge funds, also take positions in the equities, probably some of the decent size equities. And then, this all comes together to buying pressure to force the price of uranium up. So I think we'll see more of this. We'll try to get Justin on and get a real good download on the current uranium market. He hasn't been on for like a year, and what he thinks about the Sprott situation, which, I'm bullish on. I just took a cursory look at it. There's people that are smarter than me that are following it, and everybody seems to be quite bullish on it. I was reserving judgment because I wanted to see exactly what would happen. I didn't want this to turn into another hype, 232 hype, where everybody was getting, bullish on that and nothing really happened. It was kind of a big letdown. So this appears to be different. This appears to be real. Real money's coming into this fund, into the Sprott fund, and they're deploying it. And I think we're starting to find out that there's not as much material out there as everyone thought. The terms seem to be that if you sell something to Sprott, you have to deliver it, fairly quickly. So it doesn't lend itself to a bunch of monkey business where, okay, you buy it now and I'll go scrounge it up somewhere. I think they have to take delivery within 30 or 45 days, something like that. So that's why the whole thing was designed, to put pressure on the market. They know what they're doing, and maybe this is a catalyst to kick things into gear. I think it'll be good to watch what happens after Labor Day when everybody comes back to work from, which is next week, comes back to work from the summer. The summer will be over. The vacations will be over. Do fuel buyers start looking at this? Does this start kickstarting some long-term contracts? It'll be something to keep an eye on, but that seems to be what some people are speculating on. And so finally, I just wanted to point this out. This is a shrinkflation. This was a pretty interesting. I think this is at Costco. Kirkland, I think it's Costco stuff. I don't really have a Costco where I live. We just have Sam's Club, so I haven't noticed this, but I have noticed this with some other things. I had a juice bottle or something in my house. Like, this thing seems smaller than I compared it. And in fact, it was like shaved off like an ounce and a half or something. It was kind of wild. But here you have 30 rolls in 2020. You've got 30 rolls of toilet paper with 425 sheets per roll. And then below it, you have the 2021 version, and you have 30 rolls. You get the same amount of rolls, but you only have 380 sheets. And you can actually see that it's kind of seems that package seems a little smaller. You can see that the rolls here seem to be, well, it's hard to see, but nevertheless, you're getting less toilet paper, probably for the same amount of money or more money, right? That's how that works. And so this is hard to get reported into the inflation number, into the data gathering. I'm not sure that the data gathering that the government does to calculate CPI and things like that accounts for this type of dynamic. It may, I don't know enough about it, but it would seem difficult to be able to do that, to track it to that granular level. If you see like, well, you're still getting 30 rolls of toilet paper. Yeah, but do you realize that you're getting actually less sheets of toilet paper? So you're actually getting less toilet paper for the same or more money. And I'm not sure that they can account for that granular level. They may. I mean, it's like Gosplan. They have all these little bureaucrats, I'm sure, sharpening their pencils every month, but it very well could be that they're tracking it to that level. But I just thought this was another example. If you have any examples or something like this that you see, let us know in the comments, because I'm kind of curious about these things. This is a way to, again, boil the frog, if you will. You don't really see this coming, and next thing you know, you just think this is how big it is, right? This is what you get. So it's kind of interesting. It also says, another thing I noticed on here, on the upper package, it says 2 layers of softness as an absorbency, 2-ply septic safe. And I don't see the 2-ply on the bottom. So I wonder, I mean, I don't know, that I'm not an expert on toilet paper. I don't really pay that much attention to it, but that would be interesting to note. Either do they actually shave off one of the plies too and give you this thin, I don't know. And then you're having to use more to get the same effect, if you will. I don't want to get too graphic here, but it's an interesting exercise in to see how the continued abuse and rooking of the American middle class. All right, guys, that's it for this week. Appreciate the listening and the support. I didn't put a disclosure in this week. I forgot to do that. I'm trying to get this out a little bit late, but if you are interested in the newsletter, or like I said, the Patreon, hold off until September on the Patreon till I get the issue out, because I think you have a real interest in this way to take advantage of the dynamics in the Indian economy. So that's it for this week, guys, and we will talk to you next week. Thank you. Oh, one thing. If you're interested in the reality check, I will put links to the pages on the alternative sites where I post those. They will not be up till tomorrow. These videos do take me some time. So I do this one on Saturday, and I've said that I will put those videos up on Sunday. I'll actually put them up tonight, but they'll start up Sunday. And, but I'll put links to the channel so you can access those if that's your desire. All right, guys, thanks, and we'll talk to you next week.